fresh off a red eye, so we'll see how my mind works. It's okay. We're live. Okay, welcome everyone. Thrilled to have with us today Jim Diamond, who is CEO and co-founder of Diamond Properties. Jim, welcome. Thanks so much for coming on the show with us today.
Thank you. Thanks for having me.
Good. So, Jim, we were trying to. I think we met dating back to probably 1999, 2000, because this was very early on, at least in my Massey Knakal career, when you made a little bit of a foray into New York. And so we want to get to that. But maybe for our audience, maybe you could just give them a little background on your story, maybe how you got into the business, and then Diamond Properties, and then your other business, the operating business that we were speaking about earlier.
Sure. So I got into real estate a little bit sideways in terms of my brother and I had an electronics manufacturing and importing company that we'd started after college. He spent some time in Japan. I spent time in China. And we'd started this company, needed space for ourselves, bought a small building in Mamaroneck, New York, over 5,000 office over warehouse. Grew out of that in a couple of years as the company grew, and then ended up looking around, and it was a tough time in commercial real estate. So we're able to get a 140,000 square foot empty office building in Valhalla, New York, that had been a former IBM property foreclosure. So we bought it really inexpensively, knowing absolutely nothing about real estate, but just thinking we could figure it out. Built up a team, started doing our own construction from day one. Knew a construction guy, hired him, and just started demoing space and using our own occupancy as an anchor to give life back to the building. Managed to fill it up in about 18 months to 100% and take some cash out, and then reinvest in the next one, and then the next one, and realized that real estate's a lot better business than electronics manufacturing. So gradually transitioned most of our focus to real estate.
Wow. This is quite the entree into real estate. We have a lot of questions for you, but I guess for starters, when you decided to purchase the building for your business, because oftentimes you have a business, it's expanding, a lot of companies would lease. So what gave you the idea to buy it? And then, I'm very interested to hear about this vacant IBM building that you thought that you could all of a sudden transform. I mean, I would think that would be kind of taking you away from your core business, right?
So I don't remember exactly the thinking at the time, but it may have been, I think my dad had originally said to me somewhere, my dad was an entrepreneur, so I grew up in a very entrepreneurial family. He had started a number of businesses, and I think I remember him saying at some point that with a lot of companies, people build up a company, they own some real estate, and they turn around, and someday the real estate is actually the most valuable part of the company because of over 10, 20, 30 years, how much it's appreciated in value. So I think that stuck with me. And then when we had an opportunity, it seemed to make sense to jump in and buy something ourselves. We didn't realize, of course, that it was going to become a whole business. We just thought we were buying one building for ourselves.
I always find it so fascinating when people start businesses with their siblings. Did you and your brother, was this always a goal of yours? And did you always kind of work well together? Like how have you guys kind of evolved, and like what led you to be doing this together?
I don't think it was always a goal, but we've had an amazing partnership and it's been 35 years now. I'd say for the first, year maybe, when we were both in the electronics doing exactly the same thing, there'd be tension, fighting over silly decisions or whatever. But we found an amazing way to operate, specifically, especially now, where really I spend all my time on the real estate side. He spends his time on the operating company side, and there's overlap. We have two sides of the office, and we speak to each other every day, always bouncing things around. But I think a great and important key to working well with family, I think, is having your own areas of responsibility. So I take everything he says really meaningful as meaningful input, but he knows at the end of the day, like I make the final decision on the real estate side, he makes the final decision on the operating company side, and that's just I think a great way to maintain a strong relationship for a really long time. So I don't think we've fought over anything in probably 25 to 30 years now.
Wow, that is rare. that's
especially
amazing.
among siblings.
Yeah,
definitely not for my 3 sons. That's if we go a week, that's a good span of time.
That's amazing.
So what's amazing about this first vacant building that you tackled for investment, you said, well, you obviously saw an opportunity. It was a cheap buy, but then you kind of figured out, but then you said, well, we leased it up and we moved on. I mean, you would think that at the time there'd be professional real estate investors who you're competing with. Again, you're trying to figure this out as you go along. Did you just kind of get lucky, or how were you able to lease up this building without knowing much at all about the real estate business and having those connections and relationships?
Well, so I think if we'd known more, we wouldn't have done it. It was one of those types of things where a lot of experienced people passed on it. Anyone who knew the business. It was a Class B building, 1995. The real estate market was terrible then. People were coming out of one of the busts. The building had it was owned by a pension fund. It had that had taken it back. It had pipe breaks throughout it, so there were floods everywhere, and it was just a disaster of a situation that nobody wanted to touch. But
what gave you conviction then about it, besides the fact that it was cheap?
We just thought we could do it. It was that business mindset of
But the location, the building itself, you just saw, hey, this is an area, or we think there's going to be demand, or
when we wanted to set up our factory in China, Bill and I flew to China. We bought this crummy factory, shut it down, moved it to a different, better building, knowing absolutely nothing about how to do that, but we just went and did it.
Let alone in China. I mean, what does that entail as far as just showing up and buying property in China? How does that?
Well, we didn't buy the property.
Oh,
we bought the business.
Okay.
And at the time, you weren't allowed to buy property in China. Everything was owned by government entities. So we just sort of had the attitude that we could do it. We could figure it out. We started this other company, and we just, we figured we could make it happen. So we had there was somebody else in our office, Mark Blanford, we had been trying to start yet another company. We decided it wasn't going to be a good path. Mark was already with us, and we said, hey, instead of that, why don't you jump in and start working on this? And Mark became our leasing person, and still with us today, 30 years later, running all the leasing for the portfolio. So it was just the ability to pull things together that got us to be able to do it. The contractor who built that first 10,000 square foot office for us ended up becoming our head of construction. And from the very beginning, we were totally vertically oriented, where we did our own construction, property management, leasing, and accounting from day one.
That is amazing. So you and your brother both have this unique background in technology overseas. How has that shaped your approach to real estate now in the way that you're looking at these buildings?
I think we've continued to always look at each acquisition as an individual small business. And really we're really value buyers. Today we try to buy below replacement cost, try to find a gap between what we think the building should be worth versus what we can buy it for today. And it's a little bit, I haven't been in the private equity business, but I imagine it's a little bit like that in terms of identifying that gap between where the business should be and where it can be, and figuring out how you're going to get it there. And in a lot of times, a lot of cases, that's not that difficult. It's just basic execution, putting CapEx into the building, figuring out what you can do to reposition it, aggressively leasing it. We're very easy organization to work with in terms of getting deals done with tenants, our whole leasing process, our lease process, everything, construction. So I think that small business mindset of looking at it as, hey, this building is an individual business, and how do we take it from X to Y, and then trying to position ourselves with those acquisitions where sometimes we have a basic business plan that we think will be a single or double for us, and then we're trying to position ourselves where there can be a lot more upside on the horizon, where something could turn into a home run if things go the way you think they might.
Right. Well, that being said, you own over 100 assets across the country. Do you mind giving a breakdown of your current portfolio by location and asset type?
Sure. So we started in office originally, very quickly jumped into flex. Over the years, we've sort of done a little bit of almost everything, retail, couple of small multifamily things, self-storage, warehousing. We own RV parks, family entertainment centers. So we've done a lot of different, invested in a lot of different categories. 2014, we were really pivoting, trying to decide, do we focus on, we were selling a couple of assets, retail and office, and trying to decide where to focus, and really evaluated multifamily and industrial. Decided at that time that industrial was where we wanted to be. So since then, really almost everything we bought has been industrial. With that, we've expanded our geographic footprint a lot. We're now in 13 states, Midwest and Southeast. Probably about square footage wise, probably about 80% of the portfolio is in industrial. Value wise, because of the values of retail office, ratio is not quite that high. But we're primarily industrial at this point. We own a lot in Ohio, a lot in Tennessee, and then a lot of other markets like Indianapolis, Atlanta, Jacksonville, St. Louis, et cetera.
Great.
And how do you figure out where you want to be from a geography standpoint? So you're based here in New York. You have pretty substantial holdings here in the New York metro area. Maybe that's more the legacy portfolio with the office and the retail. You're making a big push, like you said, into the Midwest, Southeast for industrial. But, what is it about those states? Is it really about the deal itself? Or are you thinking, some investors are saying, well, taxes are too high in New York, I'm going to go invest in Florida. I mean, are you thinking about what's actually happening in those states? Or are you just actually looking for wherever the deal is, and you'll be opportunistic as far as from where you want to look from a geography standpoint?
No, we're careful about the geographies. I mean, I think where you're investing is probably the most important thing. So we've been looking for strong logistics markets. Like markets like Memphis have a tremendous amount of rail and air infrastructure. We like relatively dense markets. Like these days, 200 to 300 million square feet is typical of the markets that we're invested in. We're usually investing in relatively dense parts of the market. Like I don't like buying warehouses where we're just surrounded by infinite amounts of farmland. So we're hoping that when there's low vacancies, we'll see rental rate increases, and by avoiding markets where there's just tremendous potential for new construction in the submarkets where we're located, I think we're able to take advantage of that to a large extent.
And these are all value add in the sense that if you're a basis buyer. So these are not, well, maybe there is some new construction that's distressed, but for the most part, these are kind of class B, and is then the business plan just to kind of improve on that? What's the strategy as far as the type of asset that you're looking for?
Exactly. We're looking for below replacement costs, so it's typically going to be Class B buildings, but we're careful not to buy anything that we think is functionally obsolete. So we're typically looking at like 20 plus ceilings, 20 foot plus ceiling heights, good truck courts, loading, things that I don't like acquiring buildings where you're just always going to be fundamentally challenged by the infrastructure that you can't change. So good assets, ideally below market rents. We'll buy single tenant, multi-tenant, vacant, occupied. So we're very flexible in terms of what we try to buy. One of the things that's been a good thing for us over the past few years is where everybody was chasing buildings with short WALTs, we were able to look for some longer WALTs, even though like below market rents that you may not be able to realize for 5 or 7 years, we're really buy and hold investors. Like over 30 years, we've bought something like 135 properties. We still own about 105 of them. So we really are thinking in terms of the long run. So even if it's going to be a few years until we're able to see rental rate growth, we're willing to be patient with an asset.
Mm-hmm. Yeah, it's interesting. The investors who are more long term are typically able to get in at a better basis because they have patient capital and they can wait for the leases to expire to bump up to market. Whereas like someone who's looking for like the near term, like 3 to 5 years, there's a lot more competition there. So that makes a lot of sense. And so, who are your main investors? Are they more high net worth investors who are also thinking long term about generational wealth? Like who's your main investor base and how do you kind of maintain those relationships?
So when we started, it was internal, our own equity. So for a number of years, we were just investing on our own behalf, which we were able to do again, because we started really small with one building and kind of kept rolling the capital from one deal into the next, as we were able to add a lot of value and then take some of that value out with refinancing, which kind of grew into friends and family. And then about 10 years ago, we got more intentional about building a syndication platform. So now we've got about 130 people who will co-invest with us, high net worth individuals, on a deal by deal basis. We have done we've partnered with institutional capital once on a very successful transaction, but with our buy and hold long-term investment strategy, we're better off with it's a better fit with individual investors who are comfortable with a long-term hold than an institution. The institutional deal we did, we were able to structure it really well, where it was a 50-50 partnership, and we were able to buy them out after 4 years, so that it was a good win-win structure for both of us.
So a lot of our listeners, whether they're aspiring investors or they're looking to start raising capital, I think a lot of those sponsors are typically doing the 3 to 5 year deals because they get the promote, and then really they're getting the bulk of that on the sell or the recapitalization. So not that you have to go into all the specifics of the economics, but if the holding period could be forever. So what does that look like for your investors? Are you still giving them a preferential return? And after you hit that, then there's, kind of a waterfall on how you're sharing the cash flow. I assume you have fees if you're doing all this in-house, but how do you kind of align your interests with your investors and arrange for that kind of forever hold period?
So yeah, we have a standard typical structure, same as everybody, where there's a preferred return, and we don't get a promote until our investors get a cumulative preferred return and 100% of their capital back. So our interests are very aligned with our investors. We're really not at all driven by fees. We need some fees in order to support the business and compensate the team, but we're really more driven by long-term equity growth. And we're big investors in every one of our acquisitions. So our interests are fully aligned. Typically, what we've been able to do is return 100% of capital to our investors within a few years. Often, it obviously depends upon the deal and where we are in the cycle, but on some of our deals within 4 years and certainly within 10 years. So,
and that's through typically a refi, because if you're not selling, yeah,
exactly. So on a lot of our transactions, over 10 years, say, we're able to return about a 1.8x actual cash distributions to people, and then have residual equity in a property of maybe 1 to 1.5x what the original investment was. So it's a great structure where everybody's getting 100% of capital back plus return, and still ending up with long-term ownership of the asset, which I think is what a lot of individual investors are looking for. I mean, they're looking for a safe place to put their money, get a long-term income stream. A lot of our investors invest in a lot of our deals and a lot of other sponsored deals. So it's really about them putting all these transactions together and having good long-term cash flow for themselves, which is what we're delivering.
Right. Not to mention the tax benefits as well. And I mean, the structure you just described is great, because it means that your incentives are aligned with your investors, and you're incentivized to have the deal perform, because they have the preferred return, and they're entitled to, like you said, 100% of the capital first. So that's a really great selling point. On the tax front, are you guys active in the 1031 space? Like, are your investors kind of looking for 1031 exchange opportunities? Like, how do you structure your deals to enable a 1031 kind of in the future for yourselves and for your investors?
So I've done with properties that we own 100% of, or 50%. We've done a lot of 1031s over the years. I really hate selling property and not doing a 1031. I think it's only been maybe once in my career where I haven't been able to pull off a 1031. It's so advantageous, and that's really been a lot of my thinking over the years in terms of refinancing versus selling. Right. Obviously, if you can do a 1031, this doesn't necessarily apply, but especially when you're not borrowing 75% anymore. But when you were, it made a lot more sense to refinance at 70 or 75% than to sell 100% and pay taxes on the gain, when we were getting such large value increases because of the value we were doubling or tripling the value of some of these properties. So you're going to have a huge tax hit, and just realizing part of that gain through a tax-free refinancing makes so much more sense. So we don't sell a lot of properties, but certainly whenever we do, we try to make it a 1031 exchange.
That makes a lot of sense.
So Jim, I'm curious what your team looks like today, and especially on the acquisitions front, because I'd love to get more into how you find these opportunities, especially when you're going to new geographies. So if you're making this push into the Midwest, assuming you don't have broker relationships there, how's your team finding these opportunities? How are you vetting them? How do you know, as kind of being the new investor in the market, that, the local players haven't already, picked over it? So I know there's a lot of questions there, but just kind of your team that you have and how you go about finding and vetting these opportunities.
So I think we've got a great small acquisitions team. Overall, the company's about 80 people right now. The real estate side of the company, the operating side's a lot bigger because of the types of businesses we're in terms of the number of people. But the real estate side's about 80 people. the deals we find are really a mix of a lot of on-market stuff and some off-market stuff that we see out there. I think a lot of the brokers in the industrial space know who we are. We've been around long enough. We have an amazingly good reputation amongst the brokerage community, I think, both on the leasing and the acquisition side, because we're just easy people to work with. We have 100% success rate in terms of we always close deals and we never retrade deals, whether we're buying or selling. We just, we're intense about that.
Even if you find something during the diligence process, I mean, if it's a material issue, I would imagine there would be adjustments for something like that, but not just,
There's only been like one or two times in our history where somebody withheld something that material, like an environmental issue that should have been disclosed, which became an issue. But in other words, based on property condition or something with the leases, we're not looking for reasons to go back and retrade a deal or what happens in the financial markets with interest rates or anything like that. We're 100% in. And I think so when sales brokers recommend to their clients that we're the buyer to go with, they can have basically 100% confidence that we're going to get the deal done. We've never run into financing problems or anything like that. So we're just, I think it's just a question of being out there, seeing good deals. I was in Cleveland last week for a few days, looking at a couple of new acquisitions that we're interested in, and several of our about 5 or 6 of our existing properties that I was touring around. So
do you have any boots on the ground in Cleveland, or is everything run out of New York?
We do have, so we're,
because you said you do all your management as well. So do you have on-site people? How do you?
So most of the people on our payroll are located in New York, but we have a number of people who, on the property management side, especially property managers who travel around the country. We usually have a leasing person in each market that we're working with, third party, if we're not there. And we often have a local property management company as well, who's helping to, like, we may still be doing the accounting and much of the property management for the property, but we need boots on the ground. So we'll often have somebody in Columbus or Richmond or wherever who's first line of response if there's an issue with the property.
So from a building operations standpoint, I saw that you have solar roof installations at, I think it was 7 of your properties. I'm curious why, like where the incentive came from to include solar. And I'm sure your tech background has something to do with it, and just viewing the asset as an operating business and how to reduce costs and all of those things. But were there any incentive programs that were available at the time that made the project pencil at the local level or the national level? And then also, I know this is a long-winded question, but then also, are there other renewable energy outlets that you're looking at exploring, like EV charging, battery storage, things like that? Because I know like New York has a really great program for EV chargers. So I'm curious, like, what your sort of outlook is on the renewable energy side.
So we were always very environmentally focused, It for me, it really made sense. It was one of those, I love win-win things. It made sense. It was great for the environment, great for the world, and also makes sense for real estate. If you can reduce whatever it is you're using, that's great. And so, we sort of looked at solar panels as just another investment, another little mini business. And that's the way we structured it, as each one of these installations was a little solar company business on that building. And we installed all of those within a few years. They've been up for a number of years now. I'd say between 7 and 10 years. The incentives were good. At the time, they were all in New York and Connecticut. Made sense with our switch with big warehouse buildings, you have a lot of roof space. So versus office buildings, it's just going to be a lot less efficient. So it was a major investment. And it's been a good investment over time. It creates a little bit of issues. The longer you get into the hold cycle with those, creates a little bit of issue with roof repairs. Even if you start with relatively new roofs, which you need to do when you put those on. As everybody knows, roof leaks become inevitable in every building. And when you're covered with solar panels, it can become a challenge for our team to find them.
Right. And I'm sure
roof
age is something that you consider before you install the solar panels.
Right? Yeah, we only put the panels on roofs that were relatively new, less than 10 years old at the time, since these panels have a 25-year lifespan.
And are you only using the energy produced like within the buildings themselves, or are you selling it back to the grid and doing like a community solar kind of thing?
The energy is all used within our own buildings.
Mm-hmm. So I want to talk a little bit about the hospitality group. So in addition to, the assets that you own and operate, you also run many of the businesses. So ranging from self-storage, flexible workspace, and then Spins Bowling. So it's just what's so amazing, Jim, about what you're doing here is you've got many different business lines. I mean, clearly that entrepreneurial spirit, but how did you make the decision to go into that operation side as well, as opposed to just having a tenant and focusing on the real estate?
It was always just opportunistic each step of the way. So we acquired a building in Elmsford that had a self-storage business in it, occupying about 2/3 of the building. And then as we learned the business, we realized, wow, this self-storage is an amazing business, and started really, we haven't actually bought any fully stabilized or bought any other self-storage businesses. But what we've done is we've now built a handful of them within buildings that we own. So we realized great business, so let's just keep growing it.
And it makes more sense for you to actually operate it as opposed to getting a third party. Because if I'm not mistaken, the storage business is very similar to hotels, where you, instead of having a flag or a brand, you have an operator like a Public Storage, where you just pay them a management fee, and they're basically, filling up your storage. So is your thought that you can do better than, the third party manager, that's all that they do? Is it a cost savings? I mean, I don't know what these management fees run when you bring in one of these third parties, but what was the decision to say, hey, we're willing to spend the time because we can either get better efficiencies or cost savings?
Well, I think when we started, now these days, I think third party management has become quite large. But when we started, which was probably 13, 14 years ago in self-storage, it was a lot less prevalent. So it was much more typical for people to self-manage. This property had been, our original self-storage acquisition had been self-managed. So it wasn't that we took it from third-party management and brought it in-house. We just assumed the business that was already there. We had a great team of people there, and we just focused on improving the business. Once we had the structure in place, it was easy to drop the next one, then the next one, then the next one, and kind of keep growing it that way. So we've never actually, it's probably falls in that category. If it's not broken, don't fix it. It works well. And we're doing well. We're typically, 95% leased or whatever. So we're happy with it.
And you just figured out, obviously, how to advertise, how to fill the space. I mean, as opposed to, I know in the hotel front, again, you kind of tapped into the central booking agency where you get demand, but I guess it's more of a localized business. Is that how you would compete against the other storage operators?
It is. Yeah. There's no, there's a few services where you can advertise through, but not like hotels where it's hotels.com or whatever. But it's really about, self-storage is an interesting business in that you don't really create demand by advertising. It's more that when the demand is there, you want to be at top of somebody's mind. So it's really, have they driven by you a million times? And if they go to Google and search, are you going to pop up? Or any other way that people are going to find self-storage. So that's really the key, is just being there when people decide they need it. Something happens and there's a transition point that they now need self-storage. They're buying a house, selling a house, getting married, getting divorced, moving.
How many of your tenants stay long term? I'm always curious, if is the storage business, do you even know kind of what the average length occupancy is, or it just totally depends?
I think it's
people just keep their storage space forever. And
I think average would be deceiving, because I think you have some people who use it short term. They're moving, they need it for a year, renovating a house, something like that. And other people who are there for 10, 20 years. And then some commercial users who really use it as a base of operations. We have, it's sort of, you'll have constant monthly churn, but it's at a small enough level where basically the number of people moving out, you're able to replace the number of people moving in, and it's a great business because of the low capex. Someone one customer moves out, another customer moves in, you have no capex. You need to sweep the floor, and that's about it. So.
It's interesting that you're involved in hospitality as well, because I feel like hotels, more so than other assets, are really like operating businesses from a valuation standpoint. Like, instead of looking at NOI, you're looking at EBITDA. It's really the same thing, but it's like it looks like a company when valuing it. So are there any other new property types or emerging kind of sectors that you're particularly bullish on or looking at exploring? You're very diversified. You've got a lot of different hats going on.
Nothing new that we're looking at exploring, but we're like a couple of other areas that we're in. We own 5 large RV parks in Pennsylvania, New Jersey, Ohio, and New York. So that's been a good category for us.
And you operate those as well. So that business is, obviously, you have people show up, they pull up onto the park, but do you have any F&B that you operate out of that as well? Or
a little bit of F&B, not a tremendous amount. Our parks are, and this falls under the Diamond Hospitality Group side of the business, which is under my brother. But our parks are large. Like, we have one in Ohio that's 375 acres. We're bringing it up to 1,000 RV sites. Our customers are typically seasonal customers, meaning we're open 6 months a year. They spend the entire season there. They keep they have their site for 6 months. They typically leave their RV there year round, but use it for 6 months. And it kind of becomes like a second home over the summer season. People use on weekends. So they become, our properties could have 3,000 people on them on a Friday, Saturday, Sunday. They become like small towns.
Wow.
So it's a really interesting business. We'd like to, I think it's a great business. We'd like to grow, but since all of ours were highly distressed when we bought them. They'd all gone through foreclosures. At one point, we didn't always get them at the foreclosure. We got a couple from the first buyer after foreclosure, but we put tremendous capital into all of them to take them from failing businesses to 100% occupied businesses. And so just finding large RV parks that have that profile of being damaged where we can go in and fix them is not so easy.
From a demographic standpoint, what markets are, I guess, good for RV investment? I don't know anything about that space. Like, where in the country are you kind of focused, or should you be focused for RV investing?
Well, it really depends what type of park you're trying to buy, because you could buy there's parks everywhere. And the funny thing is, the reason we got into this business is because when my daughters were like 6 and 8, we started taking family vacations in an RV. There was somebody in our town who was built an RV rental business for Airstreams, and we did an Airstream trip to national parks in Montana and Wyoming, and thought this is the most amazing thing. So for a number of years, we started for 2 to 4 weeks in the summer, bringing my kids to a couple of national parks, hiking and camping. So there's a whole side of the business, which is positioning parks in high transit areas, long highways, or at destination areas like national parks where people are going to be short stay for a couple of days. And there you just want to pick, obviously, areas that are logical. But destination parks like ours, they can be really anywhere where you've got 1 to 2 hour population that's 1 to 2 hours away. That's significant.
Mm-hmm. So, Jim, thinking about your legacy office and retail portfolio, just the type of tenants that you like to attract. I saw in one of your buildings, you've got Orange County Choppers. They've got to be a pretty cool tenant to work with. I mean, is it mostly, do you prefer credit, kind of more national tenants? Do you like the mom and pops? How do you think about tenant mix when you're looking to keep your office and retail properties full?
So we're, we one of the things we always say is we're like, when we're buying buildings, is we don't buy based on tenants, we buy based on the building. We like to know, because we always assume however good the tenant is, whatever the credit is, they could go dark, and we'll always can get the building back. So we like to acquire assets where we know that whatever happens, we're going to be able to re-tenant it and replace the rent or beat the rent, which is why we've tended not to be buyers of, for example, brand new Amazon warehouses where they're paying a premium rent. We focus more on the Class B stuff. We're not that focused on whether it's credit or not credit for that reason. Obviously, if you've got a credit tenant on a long-term lease, that's great. But we're happy with very happy with local tenants as well, and that's a big part of our portfolio. What we've done, you've mentioned Velocity Office. Well, we did that. We don't own many office buildings anymore. We're probably down to about 6 or so, and those are mostly medical, which is a great space to be in. But what we did, one of the big reasons I started to transition out of office 11 or 12 years ago was because of the CapEx, and just got tired of that process of demolishing and rebuilding the same thing over and over again, moving the wall over 12 inches and starting again. So what we've done to get creative a number of years ago is we created this Velocity Office brand, which is really just the Regus Office flexible space model. And it's become very successful. We've stopped demolishing any offices. If we lose a tenant, we've got a normal layout. We're able to just put the Velocity brand on it and start leasing out individual offices. We've now got, I think, 7 locations, and they are about 92, 93% full, something like that. Probably a couple hundred individual offices at this point. They're smaller often than the big Regus. We're sort of just plugging them into individual spaces, but we find it just keeps working. People love love the model. And I think we do a great job with the build outs, with the finishes, the furniture and the colors, and making it a nice environment. Our model has been to keep that really streamlined. In other words, not trying to create a very complicated, expensive product, not the WeWork type approach, but really just good offices for a good price, totally flexible month to month.
So with this new model, are you kind of going forward looking to acquire more office, or are you kind of just running with what you currently have
just running with what we have. I think there is an opportunity for people to acquire office now. I think at good value, good basis, add value, and I think there's a business model there that makes sense. But it's not having done it early in my career. I just really don't want to get back into that heavy CapEx business of. I much prefer the industrial space is amazing because you lose a tenant. You're really the only things you have to worry about are parking dock, loading docks and parking lots and roof. And, every once in a while, now I think LED lighting will be there for a long time, but there were transitions from T8s to T5s to LED. There you occasionally have sprinkler system upgrades, things like that, but there's really not that much CapEx, and it's very predictable based on useful life of the building components.
Right. Well, now that we're pivoting back to industrial, I saw that you closed back in August on an asset in St. Louis. Could you talk a bit about that project and what made it a compelling opportunity? Like, was it the same sort of value add, long-term, below market lease strategy that you were describing before?
Exactly. It was. We bought a couple of buildings in the Earth City submarket, which is a market that we own 5 other buildings in already. So it's the market. We think it's the best market in St. Louis. We really like it. We've done well with the assets we have there, and these were just properties where we thought the in-place rents were a little bit below market, good tenants in place, occupied, but just there's and a decent cap rate going in. So it's the type of thing where the baseline is great. You're getting a good return on your investment, and as leases roll over the next few years, we think rental rates will continue to jump up. I'm sort of a believer that there's obviously in industrial, there's been tremendous supply growth. There was incredible rental rate growth post-COVID where rents almost doubled in most markets or more. Then there was so much supply as a result of that. Amazingly, like more supply built in many of these markets than the total vacancy rate today. Like, in other words, a market that's got 8% vacancy, there may have been 13% new supply added. So you would have been 4% or 5% short if they hadn't built all that space. Incredible. But now with the supply pipeline so greatly reduced, I think there's the potential for vacancy rates to drop back down to those 3, 4, or 5% ranges where you start to see accelerated rental rate growth again. One of the reasons I really liked industrial when we got into it versus multifamily, there were a couple reasons. One was management intensity, another was CapEx. Mm-hmm. One of them was I always felt that multifamily, one of the limiting factors on rental rate growth would just be affordability, because it's individuals paying the rent, and so your rents are to a certain extent. I mean, supply demand is a huge part of the equation, but also a limiting factor, depending on where you are with rents, is going to be what household income is. Where industrial is a little bit different. Prologis put out an estimate at one point that only 6% of companies' logistics spend is actually on warehouse rent, and the balance is the primary categories are transportation costs, trucking fuel, and labor. And so warehouse rents being such a small part of the logistics spend, it's not the affordability that becomes the limiting factor. It's really just this supply demand equation.
Right. Well, that's why the below market lease strategy is so effective, because you're getting the upside without putting in all the CapEx.
Yep. So Jim, as we begin to wrap things up, maybe to bring this conversation full circle, and usually, this show, I would say most of our listeners are already in the real estate space, whether they're brokers, they're owners, investors, managers. But your story is really interesting, obviously coming in as a business owner and then continuing to operate and open up all these other businesses. So, kind of why an owner of a business, again, would want to think about buying their real estate as well. Because if you think about a lot of these, maybe you see it more in the, QSR fast food space. I mean, most operators would say, I want to stay asset light because I have more money to then deploy for my business and I can grow my business faster. Whereas clearly you're making long-term investments in real estate that are more capital intensive. So again, why someone would want to make that choice of saying, hey, I want to start owning my real estate, controlling that, even if that takes away potentially of maybe some of the capital I would have to grow my business. So I think weighing kind of, how you could be successful like you have at growing both.
Well, I think both paths could work. There's not one right answer.
Mm-hmm.
If you can get a better return reinvesting your capital in your business rather than hard assets like real estate, that there's nothing wrong with that. Maybe it makes that additional capital in your business going to make a huge difference. But as everybody knows, in real estate, a big risk is just vacancy. And if you know that you can be a permanent tenant to your building, you've eliminated the business risk there entirely. And with vacancy comes CapEx, rollover costs, all of that. And when you can occupy 100% of something, you've pretty much eliminated all the risk. As long as you're investing in a good market, an area that's not declining, you still have to buy a good asset in a good location. But as long as you're making a smart decision there, and assets like real estate tend to go up over time, like with inflation, like a lot of other assets, hard assets. So if you buy something and then you're looking out 10, 20, 30 years, the odds are it's going to double in value over some period of time in your lifetime. And so it's a pretty safe place to invest.
And definitely a trend that we are seeing more of. In fact, we tracked all the office sales that have happened here in New York since the pandemic, and a quarter of them have been bought by end users, companies, which is great because, well, clearly they see an opportunity in the market, but establishing that presence, and that's happening across the country. So, Jim, this has been an awesome discussion. We really, wow, talking about a diverse experience here. I'm trying to think out of our, close to 250 guests. I think with the different businesses that you're involved with, I don't know if we've had a guest that has been involved in so many different things. But it's something certainly for everyone here. So we really appreciate you taking the time today.
Terrific. Thank you. Thank you both. It's been
so
great.
Much, Jim.
And thank our audience, as always, for joining. You can go to jamesnelson.com. This website's not about me. We built this for you, so you can go and get the show notes, find out more about Diamond Properties, how to connect with Jim, as well as a lot of other helpful tools there for you. Instructional videos. We're going to be coming out with a program. Maybe by the time you're listening to this, we'll have launched with Adventures in Commercial Real Estate, an educational program. So really here to benefit you, to gain that insider's edge to real estate investing. So until next week, thank you again for joining.